Why the downgrade? Let's start right there.
So look, I think that targets are always challenging in years like this. And frankly, the market broke lower than we thought it would earlier in the year. What we wanted to do with this target was signal that we do see upside between now and year end. We think there's a decent chance stocks bottomed in mid-June. And if they didn't, we think we could probably get that before the end of the third quarter. But really, we wanted to send the signal that we thought there was some modest upside between now and year end, that we do think you need to be leaning into recession rebound plays as opposed to really kind of leveraging up on the defensives here, which we think are overbought and oversold. I will tell you, John, that some of my sentiment models tell us that my original 4,700 target's probably still the right one. But when we look at our cross-asset analysis, stocks versus bonds, that really does temper our enthusiasm a bit.
Laura, this is important. Davide Serra over in Europe this weekend aggressively writes, take risk in credit. Serra says grab a 6 to 7% coupon, get your foot in the water, let's go. You're saying the same thing on recession rebound. Yeah. What does a recession rebound sector or part of a sector look like?
So some of the areas that typically do well are things like financials and technology stocks. These are areas that typically underperform in the drawdowns and outperform on the rebounds. So those are two areas we like. We think the financials are dirt cheap at this point in time. Our banks analysts are very, very constructive and think that even if we do have a mild technical recession, that banks will execute very well through it.
Then how will you use the GDP statistics in review this week? I get it's a first look and all that, but if the banks are doing well, that means we underestimate the resiliency of the consumer. Do you buy that line?
I think that the banks are telling you, if you look through some of the reports that we've seen so far, is that the consumer is at a very good starting point to weather whatever this economic storm ends up being called. And I think that's one of the lessons that equity investors have learned over the last 4 or 5 years, Tom, is that every time we enter one of these dicey periods in the equity market, whether it was the trade war, whether it was the pandemic itself, whether it was simply sluggish growth out there, that the consumer is pretty resilient. And that consumer starting point does seem to be very, very strong right now. I think that's getting lost in some of these recession discussions.
Laurie, the big theme then, am I playing the inflation story still or pivoting to slower growth? Which one is it? A bit of both or one or the other?
I would a little bit of both. You know, we get asked a lot about stagflation, and what we've told people is that we do expect inflation rates to moderate, but they could stay high relative to history. For that, I think you want to keep some energy in your back pocket. I'm a little bit concerned that we may not be out of the woods on energy in the very short term. But longer term, if we are in that stagflationary environment, I think you want to play there. I think that technology is a great way to sort of play that slowing growth theme. And we do see the market starting to shift away from these overvalued, overcrowded defensives back towards more reasonably valued secular growth areas of the market, like big cap technology. And I think that one of the things we've learned the last few years is that these big cap software companies in particular are the tools that companies use to fight just about whatever battle gets thrown their way. So if you think that we're sort of hitting the bottom in here, that we're going to get perhaps a better path from the Fed, that the consumer is going to stay resilient, but things aren't going to be all roses and sunshine, I think technology is an area you really do want to look at very hard.
Laurie, how do small caps fit into this, considering that you're now going overweight small caps heading into what most people think is a U.S. recession?
So look, I think you have to really evaluate what do you think has been priced into different points in the market, different parts of the market at this point in time. Covered small caps for a long time, Lisa. We know that they always have a very hard pivot midway through recession. They tend to really underperform hard heading in and on the way down initially, but they tend to really experience that pivot and outperform in the late parts of recession and on the way out. What we see in particular when we look at small cap performance against economic indicators like jobless claims and ISM manufacturing is that small caps are already trading as though we've had a spike in jobless claims and as though ISM manufacturing has plunged and hit typical trough-like levels. So I don't really need to have the are we having a recession, when is it happening debate within small cap. They are already pricing it in, and it's more clear to me in that part of the market than just about any other part.
Do you think that this means that small caps are ahead of the rest of the market, or is this a leading indicator that we're already in recession as it's going to get confirmed on Thursday with that second quarter GDP print?
I think it's going to be interesting if you do get a negative GDP print for the quarter, whether or not people view that as a recession. I think that debate will rage on. But I do think that small caps are very economically sensitive because they do have primarily most of their revenues coming out of the U.S. So if there was a technical recession in place, small caps were going to have sniffed that out. And it will really make sense, kind of the carnage we've seen in that space, frankly, since March of last year. It could make that, kind of move that we've seen make a lot of sense. But frankly, Lisa, it already makes sense based on what you're seeing in ISM manufacturing right now.